23 seconds away from the opening bell. Let's get your trading week started. Equity futures right now positive just by 0.1% on the Nasdaq 100. Just a little softer, lighter, lower, negative here by 0.15%. Also going into a key week on Wednesday, CPI, the day after that PPI. There's your opening bell. Switch on the board and get to the bond market. Going into that, yields are higher by 7 basis points. 351 on a 10-year. A little bit later on this afternoon, 2 p.m. Eastern Time, the Senior Loan Officer Opinion Survey, much anticipated. Look out for that. Mike McKee is going to break that down for you later on this afternoon. In the FX market, the euro 110.38, positive 0.2% to the euro's favour. Euro stronger, dollar just a touch weaker, and crude higher by more than 3 percentage points. $73 and about 60 cents right now. About 20 seconds into the session, let's get you some scores. On the S&P 500, we are positive 0.1%. On the Nasdaq, we are going nowhere. One sector to watch at the open, the regionals. Pac West leading the rebound after slashing its quarterly dividend. The CEO saying this: reducing the dividend was a prudent step to accelerate our plans to build capital. Our business remains fundamentally sound. Shanali has more. Hey, Shanali.
Hey, John, when we look at Pac West, remember we're looking at a bank that sold off by more than 40% last week alone amid the fears in the regional banking system. Now, listen, usually when a bank cuts its dividends, that is seen as a negative for the market. In this instance, you're seeing that big jump back after that massive sell-off last week in the vein that they are looking to preserve capital. Now, remember, we have also reported that Pac West in particular has been considering strategic options. There was another bit of negative news that came out late last week. This is idea that Fitch has placed it on a negative watch, and that is in part because of those strategic options. This idea here about the uncertainty about the strategic direction of a bank. Up till this point, we have talked about the pressure on net interest income. We have talked about the pressure on deposit flows in the banking system. And now the market is turning its attention to these bigger problems about what is a regional bank and is this business model sustainable. That is front and center with this Fitch notice on Pac West. But again, this is a bit of relief here. We know that when it comes to the idea of short selling still allowed in these markets, we are waiting to see what the SEC has to say about the sector as a whole, as even though you're seeing a green day, a lot of the worries under the surface persist. Remember, one last thing here, John, we are turning attention not just to commercial real estate, but other types of loans like auto as well, keeping a close eye under the surface.
Shanali, thank you. Some of these names trading like penny stocks. Let's just leave that board up. Pac West at 750. Bear in mind, last Monday, it opened up at 1014. By the time we got to Thursday, intraday, the low was 248. Back in Europe, when we used to cover the Eurozone debt crisis, Greek banks, the price of them got so low, you just stopped quoting the percentage point move. The 745 is a 29% move this morning, which is about $1.60 higher on that name. We'll pick up on that story later. Let's turn to the airlines. President Biden expected to unveil new efforts to benefit stranded travelers. That's coming up at 1:45 Eastern Time. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Yeah, President Biden will be speaking alongside Secretary of Transportation Pete Buttigieg at the White House, and what they are expected to unveil is new rules that would mandate that airlines provide meals, hotels, and additional compensation for travelers on severely delayed or canceled flights. It also, we understand, would force airlines to improve the availability of customer service during periods of widespread delays or cancellations. I know probably all of us have experienced that kind of headache, John. This also, according to Bloomberg's reporting, will include a revamp of flightrights.gov. That is the Department of Transportation website that basically shows what airlines have what compensation-related policies. That was initially unveiled, rolled out last year, and as a result, many airlines did then explicitly state what their policies were. So there is a question of how much actually laying out a full regulation will make a difference when some airlines have already taken action on their own. But according to officials at the White House, what they hope is that airlines will expand their policies beyond just refunds that customers are given in these kind of scenarios. Interesting, though, John, you don't necessarily see too much of a share reaction to the downside as a result of the idea of more regulation and having to pay out more to some customers. Largely airline stocks on the upswing today. Southwest, one exception. It's down just a few tenths of 1%.
Kelly, thanks for that. Let's stay there. Southwest is negative 0.3%. American is up by 3.5%. Here's a why. JP Morgan downgrading Southwest, upgrading American. The analyst saying this: the long-term relationship between discounters and the big three has inverted. It's now the larger airlines that control the high ground. Simply put, shares of American are too attractive to ignore. particularly during a time of significant international demand growth. American right now, about 4 minutes into the session, is higher by about 3%. Want to get to the earnings. This from Tyson Foods, recording its biggest drop in over 3 years after cutting its full-year sales forecast. The CEO saying, quote, a challenging market as consumers switch to cheaper goods. Katie Greifeld, that does not look good over there, does it?
No, not at all for the biggest American meat company. Cattle prices are at a record. We know that the cost of animal feed is rising as well. And like the CEO said, you have consumers trading down to cheaper foods. You add it all together, and that is hitting Tyson's bottom line in a big way. The company now sees revenue between $53 and $54 billion this year. Previously, that forecast had been between $55 and $57 billion. So that explains the big drop in shares today, down about 13% at the moment. That is the biggest drop since March 2020. Not a superlative you love to see. But let's get specific on that trade down, because you had beef sales decline about 2.9%, pork prices dropping by more than 10%. The good news, if there is good news, is that poultry sales actually climbed a little bit. And we know that Tyson is trying to beef up, if you will, its chicken segment. It said in March that it's going to close 2 of its underperforming poultry operations, so we'll see how that plays out.
Katie, thank you. No one wants a reference to 2020. Not many good things happened in spring 2020. The biggest one-day drop there since that period on Tyson. Potentially we're down by about 13%. In tech, Apple tapping the debt markets. Bloomberg learning the company is set to kick off a 5-part corporate bond sale that could lift issuance by more than $5 billion. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. $5 billion, you said, in as many as 5 parts, according to our Bloomberg source. It's interesting because the longest portion of the deal, a 30-year bond, could yield around 135 basis points over comparable treasuries, according to that source. The timing is kind of interesting. I think we have as many as 15 issuers looking at the market this Monday. We get CPI Wednesday, PPI Thursday, trying to get some stuff done, probably before that data print later on in the week. The other way to look at it is this a sign of the corporate debt market stabilizing somewhat. Apple is not the first mega cap to go and tap the market. Last week, Meta sold about $8.5 billion in what was only its second ever bond sale. The other thing for Apple is that this would be the first bond sale since August, when they sold around $5.5 billion to fund share buybacks and dividend payments. And I think the expectation from Apple's perspective is that this year we could meet or exceed around $100 billion in shareholder returns. And Bloomberg source saying that this new sale could fund that, along with sort of general corporate purposes, capex, working capital. But yeah, interesting timing given the data that I know is coming later this week, John.
I was looking at use of proceeds, and it was basically just everything listed there, yeah, including capital returns. Ed, thank you for that, mate. There is a sense, there is a window here ahead of the debt ceiling mess to issue debt. 30 to 35 billion of US high-grade bond issuance expected this week, according to the team here at Bloomberg. Kathy Jones of Schwab saying just that. Maybe this is some companies trying to get out ahead of all of that. Sticking with tech, Citi's Stuart Kaiser staying long the sector, saying this: the tech thesis is less clean than to start the year, but we don't see a compelling sector alternative at this point. Stuart Kaiser joins us right now. Stuart, are we saying Tina's still a thing? There is no alternative to this?
Hey, Jonathan, good morning. Look, I think from a tech perspective, yeah, it's you know, you're at a situation where short valuation is pushed higher, and we've definitely seen significant flows come into the space, but we do think there's still room for long-only investors in particular to add to exposure. And, you know, you've highlighted a lot of risks this morning around growth, around credit, around sentiment. And, you know, and if that's the case, we do think the tech sector is a good place to kind of be in that situation. So, yeah, we're still on the sector, but would, you know, acknowledge that things have obviously changed quite a bit year to date.
Stuart, I always wait there. Sunday afternoon, I'm logged onto the Bloomberg, I'm doing my work for the week ahead, and your note always drops right there, right on cue. And your note this week started off with this, and I thought it was interesting. Markets were risk off for the week, but we are very surprised by the rally on payrolls. Investors seem happier about not bad growth data than concerned about hawkish wages. Now, Stuart, is good news simply good news at the moment, and how sustainable is that?
Yeah, look, I think particularly right around, you know, when we started to get the regional bank stress, people started to really worry about recession risks and a pullback in credit. And I think what that did is it probably put growth, you know, as priority number one over inflation for a period of time. And that's clearly what traded on Friday, right, which was, you know, a strong payrolls number, though with negative revisions, and a very, very hot wage number. But the market seemed to really embrace the payroll side of it. we didn't see this kind of short-term rapid deterioration in economic growth data that people had feared, and for that reason the market moved higher. I'd also say, and we mentioned in the same note, is that you had a tremendous amount of really kind of tail risk kind of hedging in the system. So I think there were some people that were maybe clenching their teeth a little bit about a big downward surprise, and when that didn't materialize, a lot of that positioning probably got cleaned up a little bit on Friday.
There seems to be some belief as well that we can enjoy this data without the threat of higher interest rates. From your perspective, Stuart, in your opinion, just how high is the hurdle to another hike of the Fed?
Look, I mean, they said they're data dependent. So, as you talked to Andrew Holenhorst on our econ team, and we do expect a hike in June. So, in our view, it's possible, it's in play, and it's largely going to be determined by the data as it comes in. And that's why we were so surprised on Friday. That was the hottest wage print we've seen since March of 2022. Certainly going to get the Fed's attention. Inflation, we have 2 more inflation prints and another job print before the FOMC. So, to me, June is kind of still in play. I know the markets aren't pricing that, so it's data dependent, and that means to me, you could get higher yields in June.
I just want to pick up on the market pricing right now. PacWest is fading. That stock was positive. It was through and approaching about 750. The stock coming just short of that, in and around that in today's session. It's pulled back to about 683. Not many people are constructive on this sector right now, Stuart, so I wasn't surprised to see the word cautious in your note on some of these banks, but you said cautious until private capital buys assets without a federal backstop. Stuart, can you talk me through just how you're thinking about this sector at the moment?
Yeah, look, John, it's a large and hugely complex issue, so we've really just tried to simplify it down, and that's until we see private investors willing to put cash into the space without, a federal backstop or the FDIC absorbing losses, then we're going to remain cautious, because what that's telling us is that institutional money does not see value in that space right now. And if they don't see value in the space, I don't understand enough about it to get involved. So, I mean, if you look at the deals that have happened, whether that's, in Europe or the 3 in the U.S. so far, the FDIC has written an 11-figure check in most cases to support those deals. And from my perspective as an individual investor, I just don't think you could put your money to work in that space while that's ongoing.
Stuart, it's amazing to see the S&P financials on the S&P 500 sit right on top of that 2007 peak. That means it's basically 16 years with no returns from that peak point to point, from then to now. Stuart, do you think that maybe after the bust of the last 12 months in big tech that maybe we might be saying the same thing at the index level on the S&P 500 in 10 years' time?
You mean an extended period of sort of flattish returns?
Yeah.
Look, I mean, anything's possible, Jonathan, but I guess my pushback there would be, the equity markets have worked in higher inflation and higher rates, environments historically. And really what the markets want is some form of clarity. So, I think if we have some clarity on the rates outlook, some clarity on the inflation outlook, even if it's at a level that the Fed doesn't love, that equity markets can still work in that environment. And remember, the S&P 500 is a dynamically rebalanced portfolio, right? That's constantly increasing the weight of the highest ROE businesses in the world. So, I don't see why we'd be sort of dead money for a 10-year period. Realized valuation is a little high, and I realize there's a lot of challenges out there right now. But, I think if you step back, big picture, if you were to get rates volatility down, get some clarity on the inflation outlook, I still think equities can work. Risk reward obviously isn't great, and when you can get 5% yield in cash, obviously that's a high bar to get you back into equities. But no, I mean, I don't think we're calling for a 10-year period of dead money at this point.
Stuart, thanks for indulging me. Sometimes it's hard enough to get past next week, so why not look through the next decade? Stuart Kaiser there at Citi. Stuart, appreciate it, sir, as always. On the S&P 500, about 13 minutes into the session, we are positive by just 0.02%. Some of these gains out there fading at the moment. Coming up, the regional banks trying to rebound.
The information that we have at this point is that the situation remains under control. The president is certainly looking at the options on the table.
A conversation up next.
The information that we have at this point is that the situation remains under control. I think there are indications that we are in a better place, certainly, and we continue to watch the situation as it unfolds. The president is certainly looking at the options on the table.
I can say the administration is going to closely monitor the market developments, including the short-selling pressures on healthy banks.
It's quite literally my favorite phrase in Washington, D.C. We are closely monitoring markets. I still have absolutely no idea what that means. The regional banks this morning trying to stage a comeback. PacWest leading those names higher. This is Mohammed Al-Erin of Queen's College, Cambridge, warns there may be another leg to this story.
Now we have stage two, where banks that are not particularly badly managed, they have issues, but they're not particularly badly managed, are suddenly vulnerable. And they're vulnerable to this path dependency, this multiple equilibria.
Let's bring in the team. Kelly Lyons back with us alongside Sonali Basak. Kelly, these gains on PacWest fading just a little bit.
Yeah, this is a stock that opened 30% higher on the day, now up just about 20%. And I say just, John, still objectively a really big move, but relatively when we look at the moves on this stock we have seen of late, it may actually seem quite small, because remember, this is a stock that is coming off of an 80% gain from Friday. Even with the gains, though, over this session and last, is still a stock that is down 70% so far this year. So we still have a long way to go to undo that damage. Now, it's interesting to see the move this morning, despite the fact that the bank said it is going to slash its dividend. Analysts don't seem too surprised by that move, actually saying that it makes sense considering the bank wants to focus on capital building and the pace of that. So investors really seem to be taking it in stride as well. It raises a question, though, of whether or not we really have seen the worst of the selling pressure for both PacWest and some of its peers like Western Alliance, Zions, Comerica, others that have gotten caught up really in just this negative sentiment around regional banks. There was a question at the end of last week if that selling pressure had been overdone, if really what we were seeing in terms of the price action matched what was happening with bank fundamentals. And we also are still awaiting potentially more positive catalysts in the future. Morgan Stanley in a note this morning talking about the idea of potential changes to FDIC deposit insurance. Of course, John, that is something that would require congressional buy-in. And for that reason, we'll be looking ahead to the Senate Banking Committee hearing with regulators that's scheduled for next Thursday.
And trying to stage a recovery here, trying to rebound on PacWest, on many names on the regional banking index, which has been absolutely hammered since early March. For the broader market, about 20 minutes into this session, the S&P 500 rolling over, turning negative, down by 0.1%. Yields higher at the front end by 6 basis points. Let's call it 398 on a 2-year. Do we need a countdown clock, Sonali Basak, for the Senior Loan Officer Opinion Survey, which comes out in about 4 hours' time?
Listen, this is a slow bleed. Remember, John, we have seen tightening standards for a number of quarters now. You really have to go back to the beginning of last year when you saw any easy and unchanged data when you looked at the loan officer surveys here. That was when banks were trying to capitalize on higher net interest income on the heels of rising interest rates. Now, there's some other interesting data that has come out on the heels of this report to take a look at to complement, really, the report that we're going to hear today. Goldman Sachs, for example, now reporting that 77% of respondents of their small business survey say that they're facing a credit crunch. And that is such a hard turn from a year ago when 77% were confident in their ability to access capital. So hard turn there. I think this is the ability to turn on a dime when we're watching the loan market here. I also like the special questions. Frankly, last time the banks were asked about the lending standards, they not only said almost every type of loan was being tightened here in terms of the standards, but they also expected almost every type of loan type to deteriorate in quality. We saw that from the January survey. Are we going to see some very kind of negative tones here when we look at the commentary from the loan officers?
Credit crunch, you said it, Sonali. Torsten Slok said it too over at Apollo. Torsten Slok over the weekend saying that these regionals face difficult issues, higher funding costs, lower asset prices, more regulation. Sonali, just how hard is it going to get for some of these banks once they get through the storm? Yeah,
look at the immediate storm that we're seeing here. You see it in the intraday volatility here of all of these stocks to begin with. But then again, I think the problem here is when you look at it, the horizon, that horizon just keeps getting further and further, John, when you think about the banking models that these firms have to contest to the point that Citigroup was making a little earlier. Stuart Kyle riser. Private capital is going to play a key role in this. You saw them step up with PacWest to some degree, but only with a form of collateralized loans here that they could feel safe with. We have not seen a wholesale shift into the private capital markets stepping up. So where does the funding come from if depositors are so flighty? And what is the business model even past this initial storm?
Shanali, thank you. 693 right now on PacWest. Shanali Basak there. Kelly Knights, thank you very much. For the broader market, about 22 minutes into the session, your equity market on the S&P slightly negative. We're down by about 0.1% with a sector price action. Here's Abby.
John, well, today's small decline, this move to the downside, at least right now, it has everything to do with big tech sliding. Let's take a look at the S&P 500 IMAP. We will see tech as the worst sector, down about 0.5%. It's the sector's big weighting to the index that's really creating a problem. Microsoft, Apple, Nvidia, Amazon, Meta, Broadcom, these stocks are all lower. Consumer discretionary also lower, and that includes Amazon, of course. To the upside, though, is one that we have not seen all that much in recent weeks. Energy up 1.4%. This as oil is climbing higher again at $73 per barrel. In fact, over the last 2 days, we have energy higher, up 4.1%, even as oil up till today had been sliding for multiple weeks. John, a little bit of a reprieve for the energy sector.
Abby, thanks for that as we kick off the trading week. Looking ahead to some inflation data later on this week. Your trading diary up next. .25 minutes into the session, just turning a little bit lower on the S&P 500, softer here, negative by 0.1%. That's the price action. Let's get to the trading diary. The highlights of the week ahead. President Biden speaking on the airlines at 1:45 Eastern Time. The highly anticipated senior loan officer survey at 2 p.m. later on this afternoon. The May financial stability report coming later as well. And Minneapolis Fed President Neil Kashkari discussing wages too. Tomorrow, it's the president's debt limit meeting with congressional leaders. The US CPI report out on Wednesday, and finally PPI and another round of jobless claims on Thursday from New York City. That does it for me. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, May 8th. Here are the top market stories we're following for you at this hour. Clues. Senior Loan Officer Survey drops at 2 p.m., offering the latest read on bank lending. We're going to find out just how deep the credit crunch could be. And the bank bounce. PacWest soars for a second day after cutting its dividends as its business remains sound. We're going to get the latest. And the debt deadlock. White House preps for a meeting with congressional leaders Tuesday as Janet Yellen warns of no good options other than lifting the debt ceiling. From New York, I'm Alex Steele with Danny Berger over in London. Guy Johnson still recovering from his coronation hangover. Welcome to Bloomberg Markets. How was it? Like, did you do stuff? Did you have the coronation quiche? What?
I mean, kind of. It was raining outside all day, so I didn't really do anything. I watched it on TV, so I'm a little suspicious of Guy needing to take this holiday off. But yeah, maybe he's at home making a coronation quiche. Alex, it's got beans in it. I don't understand this country. It's a strange world when it comes to food here.
Well, I mean, hey, as long as it has sardines, because he's a real sardines freak. So anyway, if it has sardines, he's probably eating it. But it's nice to have you for the day.
So happy to be here. But look, the most important thing obviously isn't that the king is still king. It's the SLOOS data coming up. It is the Senior Loan Officer data. That is going to be what we're focused on. That is going to be giving us a read on exactly what type of lending environment we're dealing with right now.
Yep, and sort of, do we have real-time signs now of credit really tightening, and then how that winds up transmitting itself to swaps, to the bond market, and kind of what we're already priced for at this point?
Yeah, exactly. Look, Powell has seen at least a draft of it. He mentioned the SLOOS data 3 times in his speech when he made the decision last week. And all of that brings us to our question of the day. Do we have a credit crunch crisis? Will this data reveal something more pernicious in this economy? Joining us now to discuss is Bloomberg's Edward Harrison and Michael McKee. Mike, let me start with you. What are we expecting from the data when it hits 2 p.m. New York time?
Well, it's going to tell us what bankers told the Fed in April about where they are with their credit standards, whether they've tightened them significantly or tightened them slightly. We know that in January, the last time this survey was done, that 43% said they had tightened at least somewhat. Now, the interesting question is, what are we going to see from the banks beyond just the survey? And what we're seeing already now is that there's been a big drop in business loan demand as well. So is it credit standards tightening, or is it companies don't need the money right now and aren't applying for credit? That's something that we will not learn from the SLOOS.
Edward, what do you think? Any signs of a credit crunch crisis being revealed today?
No, I don't think there are going to be as many signs as will be in the future. I think that this is yesterday's data. What we saw today was PacWest. They cut their dividend from 25 cents a share to 1 because they understand that they need to hold on to cash. So I think the events from last week are enough that what we see in the data today will inform us how much worse it will be going forward. Another thing that I think is interesting is in that context, Jay Powell didn't seem to be that negative on the data that he had already seen. When we actually see the data, will we therefore understand that he's downplaying a more significant story, or is it in line with what he said, which is a slow tightening, which allows the Fed to continue to hike interest rates, or rather to keep interest rates on hold for a considerable period of time?
Oh, yeah, that's really interesting. Is there some degree which he doesn't want to spook the market, Ed? I mean, how bad would it have to be in order for this to be the thing that stops the Fed from another hike, another 25 basis points, and perhaps gets to what the market is saying, which is cuts come year end?
I think it would have to be relatively bad. I mean, more of a progression from what we saw in the last data that we saw. And I think there are three things that are going on here. One is that we have this regional bank tightening, which is precipitated by deposit outflow because people are looking for higher yields. But then you also have continuing claims that have gone up. They've gone up actually 500,000 in the last 6 months. And that's a sign that the labor market is weakening more than we might expect from the jobs numbers. And then, of course, you also have signs that the bond market is expecting things going forward with the re-steepening of the yield curve. That suggests, recession could be on its way. All of that wrapped up with the debt ceiling, and it says that we're going into an environment where, in some ways, this report is yesterday's news, and that we're coming into an environment that is more challenging.
But Danny, from what I understand, is that this kind of data leads by about 12 months. So if we do see a crunch, that could very well portend like where we're going to be though within the next year, which is kind of interesting.
And that is also an argument, Alex, as to why this is more important than CPI data this week, considering that is backward looking. Mike, is that fair? Do economists care more about SLOOS today than they do the CPI this week?
I don't think so, and I don't think people trading on Wall Street care more about CPI or care more about the SLOOS, because the CPI report is going to give us much more of a clue as to what the Fed is going to do. The Fed knows what the answers to the questions were on SLOOS, but at the same time, they can also see lending patterns. As Edward said, this is old news. The SLOOS was last month, but current lending, after a short drop in March, has now picked up again. So if they have tightened credit standards a lot, we're not seeing it in the ongoing lending data. And so that says something that kind of tells the markets that it probably matters more what prices are doing, because that's going to tell us more about how long the Fed is going to stay up there with its interest rates.
Right. So in a weird way, like if credit conditions are good, is it like a good news is bad news then for the market? And is that we're kind of seeing in the bond market and getting ahead of that, right? Because it means more work for the Fed, et cetera.
Well, we're in this weird period where everybody has expected certain things to happen. Last week, we thought we were going to have maybe some sort of sign of slowdown in the labor markets. We're not getting it. That suggests that the Fed has to stay higher for longer. We may get a less than terrifying SLOOS report today. We already know that bank lending is recovering. So where are we? It's very hard to tell. About the only number we do have, at least something to hang on, is inflation with CPI or PCE. So I think that's why people will be paying a lot of attention to that.
Yeah, it almost feels though like this environment where there's so many different directions, so many different possibilities. We're kind of just hanging on to whatever data point fits our narrative. But Ed, to your point, I mean, there is so much going on. Sprinkled among the many things you mentioned, of course, was the debt ceiling too. Alex and I are, of course, going to be talking about it throughout the show. But at what point does that take center stage for this market and this economy?
It all depends on what the income tax data look like, because at the end of the day, once the Fed, or rather once the Treasury runs out of money, then I think it's going to have an appreciable impact on the economy. GDP now for Q2 is at 2.7%, which is relatively robust. So you have to have a number of different things combining in order to bring things down. A slowing of the economy, the debt ceiling, wiping numbers off of GDP, all of those things will come together. But as it stands now, it looks like the income tax data are good enough to give us until July. So the beginning of June date is likely not going to be the date that we care about.
Right. No, of course, it's going to be pushed back a bit there. All right, guys, thanks a lot. Super appreciate it. Edward Harrison and Michael McKee. Great to get your perspectives and for setting us up for the next hour. Coming up, question of the day will continue. Do we have a credit crunch crisis? To Emily Rowland of John Hancock Investment Management. She joins us next. You get S&P pretty much flat on the day. This is Bloomberg.
we have all the ingredients of a so-called Minsky moment, right? You see that everywhere these liquidity pools or liquidity crunches are starting to be visible. And so, of course, the commercial real estate and the doom loop with the regional banks in the U.S. is a concern.
That was Allianz chief economist Ludovic Subran discussing the pressures on global markets, which helps us to the question of the day. Do we have a credit crunch crisis? Will any of that be revealed today when we get the SLOOS data out in about 4 hours' time? Emily Rowland, John Hancock Investment Management Co-Chief Investment Strategist, joins us now. Emily, what's your call? Do we have one? Do we get signs of one?
Well, we'll certainly know a lot more later today, but some of the high-frequency data that we're seeing really isn't showing a deterioration in bank lending yet. In fact, loans were up for the 4th straight week at commercial banks. We're seeing a normalization in terms of the trends and deposit flows at banks, and we're seeing high-yield bond spreads also acting very much contained, well under 500 basis points. Which is their longer-term average. So, again, more information coming, but some of the most recent data suggests we're not really there yet.
How much is the story of a bond market cut is 225 basis points worth of cuts by January 2025? How much of that is dependent on a credit crunch?
2025. I mean, I feel like next month is just a world away. It's tough to think that far ahead. But I think, the Fed is caught in this almost tug of war right now because on one hand, you have tightening financial conditions, which is inherently disinflationary and would argue for a pause or even cuts in the back half of the year, which of course is what the bond market is pricing in. But then you have these stubborn pockets of inflation. We'll learn more about this on Wednesday, but areas like core services, ex-housing, which remain troublesome for the Fed. And then of course the labor market just won't quit. You had this big upside surprise last Friday, which sort of saved the day in terms of the macro data last week, and you have wage growth accelerating. So the Fed is very much focused on the inflation part of their mandate right now. And if inflationary pressures remain elevated this week, then I think they're going to have a tough time pausing in June. The bond market's pricing in a 90% probability in June, and we'll see how that shifts.
Ooh, Emily, are you kind of talking up a 25 basis point hike right now in June?
I think it's possible. I think the door is back open to that after the labor market report last week. And again, some of the data that we'll get on inflation, wage growth, again, elevated in that jobs report last week. So I think it's there. The Fed has, they hinted at this idea that a pause may be coming, but then backtracked on that a little bit. In the first question in the press conference and reiterated that they're going to be data dependent from here. They have not made a decision yet about pausing, and we read that as hawkish on the margin.
Yeah, Alex, I mean, Emily makes a great point, especially given that data on Friday when we had wage data still hot. The payrolls figures, they aren't cracking yet to where they need to be for the Fed to stop.
Right, which is where we can kind of talk up the SLOOS all day we want. But how bad does the SLOOS have to be to really put more cuts or take off the possibility of potentially a hike in June? Emily, do we get a credit crunch crisis at all?
I think that none of us know exactly the extent to which these challenges within the regional banking system are going to be extended. I think there is a loss of confidence in the system, which is contributing to some of the challenges there. But then you're seeing this bounce. In the regional bank names, there may be an element of short covering there, but I think you're going to likely see some more consolidation. I think that there's a hope there that element of consolidation can really kind of help stabilize things. The larger banks are well capitalized, they're in a good position, but what happens when the Federal Reserve raises interest rates to the extent that they have over the past year? Remember that interest rates were pretty much zero about a year ago, just over a year ago. Not pretty much, they were zero. So we've just put a massive amount of Fed tightening into the system, and we're starting to see companies with too much leverage and that are subject to solvency risk having these issues. That is always what happens. The Fed over tightens until something breaks, the tide goes out, we're left to see who's swimming naked here, and that process right now is just beginning, and it's a key reason that we're trying to protect against solvency risk in our asset allocation views. We like higher quality assets. We think bonds can do more heavy lifting in portfolios this year as we wait out in an environment where we do think things are going to get tricky from a credit perspective.
But is it banks that are still likely to have an issue in this environment, Emily? Because I'm looking at some of the fundamentals. Deposits, they were steady last week when the price action was anything but.
I know, and to be honest, I don't know that these challenges of liquidity getting removed from the system are just going to be impacting the banking system. There are other companies, unprofitable, growth at any price, zombie-type companies that are also likely going to be impacted. It's pretty easy to run a zombie company when interest rates are at zero, because you can simply take on more leverage for free, of course. And so now, again, we're starting to see the lagged impact of Fed and really central bank tightening globally start to impact these businesses. We want to be really, really mindful of how much risk we're taking. We don't want to reach for risk. Owning these growth at any price companies, want to protect against valuation risk by leaning into value and own higher quality assets. And once again, emphasize bonds and portfolio. The fact that we're getting 4 to 5% yield income owning high quality bonds. Income is something that we haven't had very much of over the last 10 years or so. And I think this is an important moment for investors to consider legging into duration and letting bonds do their job in a portfolio.
So when it comes out of value stocks, is that what you were talking about when like finding value? And do these kind of companies maintain pricing power?
Yeah, so we do like value, particularly in the mid-cap value space, and that is one area in which we are actually finding pockets of the market that are trading at a discount. That's pretty tough to do right now, considering that the S&P 500 is trading at about 18 times forward earnings, which we think is a pretty generous multiple, given where we see the macroeconomic environment go, which is, heading towards recession here. So we want to find areas that are trading at a discount. Mid-cap value right now at about 13 times forward earnings. Good earnings trends there. We think it's a beneficiary of reshoring, onshoring as supply chains come back to the U.S. We're also looking at a period in which you see this almost kind of revolving earnings decline or kind of rolling earnings decline, where areas that do have pricing power, like industrials, materials, those actually tend to see their earnings hold up the latest in the economic cycle. So another reason that we're leaning into value areas like industrials here.
Yeah, and this should come as no surprise, but Mike Wilson is out with another note saying that some of that economic weakness does indicate that margins are going to deteriorate, but, he has been saying that for some time, but he has been mostly right, so hats off to him. Emily, afraid we're going to have to end it there. Thank you so much for joining us today. Emily Rowland of John Hancock Investment Management. Still ahead on the program, Apple comes to the debt markets. The company kicks off a corporate bond sale that could lift issuance by more than $5 billion. We've got the details for you in the startup next. This is Bloomberg.
Time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Simone Foxman. Meta says it could stop making news content available on Facebook and Instagram in Canada if lawmakers go ahead with a law that would force social networking platforms to pay media publishers to feature their work. The company says the proposed Online News Act is, quote, fundamentally flawed. The act would also provide for collective bargaining by news outlets. Crypto exchange Coinbase is considering the United Arab Emirates as a place to set up an international hub. That's according to CEO Brian Armstrong, who spoke to Bloomberg TV. Armstrong's been vocal about the lack of clarity in current U.S. crypto regulation, but he says Coinbase is not going to leave the U.S. And first quarter earnings plunged 26% at KKR. A deal-making drought continued to weigh on the alternative asset manager. Meanwhile, assets under management grew 6% to $510 billion. KKR's traditional private equity portfolio fell 9% over the past 12 months as the firm marked down the value of investments. And that's your Business Flash. Alex.
All right, thanks so much, Simone. It is 22 minutes past 7 on the West Coast. We want to get to the startup. We cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts its morning, joining us now is Bloomberg Technology co-host Ed Ludlow. Ed, Apple's going into the market, issuing a lot of debt. Walk us through it. And I wonder, is it pre-CPI getting in there before it's too late?
Yeah, it's interesting timing, right, because we have CPI and PPI on Wednesday and Thursday respectively. I think there's 15 issuers out in the market this Monday, so the timing does indicate that. For Apple, $5 billion in up to 5 parts, the longer duration part of the deal, 30-year bond yielding potentially 135 basis points over comparable treasuries. You have to remember, in the context of Apple, it's confusing. You look at its massive pile of cash, you look at the balance sheet, also its massive pile of debt, but this is what they do, and they do it regularly. Last August, they sold $5.5 billion of debt, principally to fund share buybacks, dividends. And if you think about the strategy for Apple going forward and its shareholder returns strategy, it's kind of in line with that.
So what is it then? Is it just, hey, we're confident that we're going to continue to have cash flow?
Yeah, I think, they have a net cash neutral goal long term. I think, common expectation is that shareholder returns in whatever form are going to hit and exceed $100 billion this year. They authorized an additional $90 billion of share buybacks at the last earnings last week. God, earnings was just on Thursday.
Yeah.
I lose sense of time and space. But I guess the point is, borrow money because you can, not because you need to, right? And Apple is in this enviable position, as well as this idea that there's some sign of stabilization in the corporate debt market. Apple's not the first mega cap.
Yeah.
Meta tapped the market last week.
Yeah, different issues for sure. But what about the maturity wall? Do they have any debt coming that they also need to kind of pay off, et cetera?
Well, again, borrow because you can, not because you need to. If you think about servicing the existing debt, that net cash neutral goal, borrowing is basically at zero. If you think about it from Apple's point of view, you're borrowing in just very favorable terms. You want to preserve that cash position and you have that net cash neutral goal. Just borrow, service debt. But I would say, according to a Bloomberg source, every reason under the sun is listed for why they're raising money, from general corporate purposes to funding shareholder returns to CapEx to working capital. So.
Fair enough.
And as you say, Ed, it's why not, right? If you can do it, does this just put more confidence into the big tech story, into this being the market leadership for 2023, which I'm pretty sure is the year, as we're losing track of time?
Yeah, yes, in Apple's context, but I go back to Meta. So Meta sold $8.5 billion last week in what was only their second ever tapping of the corporate debt market. And for them, the story is very different, right? They have to work out their working capital and at a time where they're trying to work out cash flow and operating expenses, because Zuckerberg's under pressure from that standpoint. But yeah, Apple is in this enviable position where it can basically manage its cash position very actively. And at the same time, the focus for Apple is definitely shareholder returns. Another reason the Bloomberg source listed was possible M&A, but really,
Yeah. Fair
Check
enough.
out that balance
Ed,
sheet.
thank you. Yeah, a lot of cash. Ed, thanks so much as always. That's Bloomberg's Ed Ludlow. And of course, you can catch Ed as co-host of Bloomberg Technology. That comes up in around 90 minutes time at noon Eastern. That's 5 p.m. if you're here in London. Coming up, we're going to talk Yellen and the warning over the debt ceiling. This is Bloomberg.
We're about an hour into the U.S. trading session. Volume, though, super light. Abigail Doolittle is tracking these moves for us. Abby?
Super light. A super small, relatively small decline here for the S&P 500. It felt as though we were going to go higher earlier with the futures higher, but at this point, the S&P 500 down about 0.2%. The day is young, and to Alex's point, we also do have that light volume. So let's see what can happen. Tech is the underperformer on the day, the worst sector for the S&P 500. Apple had been sharply lower earlier, now down about 0.1%. Or actually, I should say down about 0.5%, of course, on that bond offering that Alex and Danny were just talking with Ed Ludlow about. And the big question, does that signal that all clear for the month of May when typically there are more offerings? Let's see. Microsoft, the biggest point drag on the S&P 500 today, down about 0.8%. Now, if corporate bond offerings are big this May, will that mean that there's going to be less demand for treasuries? We don't know, but over the last 2 days, we do have a bit of a slide for bonds. This is the 2-year yield. It is up 19 basis points. That, of course, means that price is down. But the 2-year yield still right around 4%. That 10-year yield right around 3.5%. So I think it's way too early to say whether or not that is going to be the case. If we take a look at a measure of volatility, the VIX, let's take a look at the VIX curve. Well, actually, this is a terminal chart. The VIX curve right now is pretty benign, suggesting this adage around sell in May and go away. I'm not sure that that's what's going to happen happen this year. If you do sell them, go away, maybe we stay sideways, but you can see the S&P 500 really trying to break out of this range. The RSI, a momentum indicator, also trying to break to the upside toward the oversold territory. Net, Danny, I would say that this chart is relatively neutral to constructive. It's more constructive, actually, but until it breaks out of that range, it's hard to really say that for sure. But it seems as though the bulls are trying to get something going.
Yep, and there's the VIX curve you're talking about, a snoozer, if you will. Abigail,
Yeah.
Thank you so much. Abigail Doolittle there. Now, potentially not a snoozer. Treasury Secretary Janet Yellen was cut her G7 trip short to Japan as worries about the looming debt ceiling showdown escalate. Over the weekend, she told ABC's This Week that involving the 14th Amendment to avert the debt limit breach would provoke a constitutional crisis. Take a listen.
All I want to say is that it's Congress's job to do this. If they fail to do it, we will have an economic and financial catastrophe that will be of our own making. And there is no action that President Biden and the U.S. Treasury can take to prevent that catastrophe.
Let's bring in Isaac Boltanski, Managing Director for Policy Research at BTIG. Isaac, at this point, how worried should we be about a possible breach of the debt ceiling?
Look, it is a viable possibility at this point, right? But I really think that it's still highly unlikely that we breach the debt ceiling. I think instead, market participants have to be ready for a messy few weeks, right? Mm-hmm. We're going to have this big powwow tomorrow at the White House. That's going to drive some headlines. My expectations are pretty low for that. But then I think we have 2 straight weeks of headlines and nonsense and crisis posturing and finger pointing that's really going to frustrate market participants who are just looking for clarity.
Yeah, yes. Isaac, so I guess the question is, what kind of, market impact do we need to see to light the fire that's going to actually get the deal done? When I feel like the whole world of Wall Street execs calling up Congress and being like, guys, get it done, isn't going to work this time.
Yeah, look, I do not think that most of the main participants in this story are going to be impacted by the external parties that they're impacted by back in 2011. I do not think that most members of Congress are going to care if big bank CEOs call them and say that the world will burn if they fail to do this. Mm-hmm. Instead, I think that we have a bit of kabuki theater here that we've got to go through. And that is, I think on Tuesday, tomorrow, we're going to have that big White House meeting. And I think that the White House will come out and say that they are willing to negotiate on certain elements of the budget, spending caps, things like that. At that point, you can then try to narrow the bid-ask spread between Kevin McCarthy, the Speaker of the House, and President Biden. That's going to take about 2 weeks. Mm-hmm. At that point, you're really running up against the clock. And my bet is we're going to have a short-term punt at the end of this month.
So, and this comes, Danny, after a Washington Post ABC poll that showed that President Biden's poll numbers are just continuing to slip, and he has a job approval rating, Danny, now at a new low of 36%. Danny, it feels like that's not the condition that you want to be actually trying to govern in.
No, it's not. You want to have negotiating power. This certainly doesn't help. I should say he does have a presser later today about compensating passengers for flight delays and cancellations, so I'd assume that would be popular with literally everyone. But Isaac, what do you make of this poll? What do you make of this setup into the election?
Look, we have to do our best, given that we are about to enter a presidential election cycle, to not put too much onus on any single poll. But boy, that was an ugly poll. Mm-hmm. That cannot be a fun Monday morning for most White House staffers. And I think that it shows you that we're about to enter a pretty bruising time politically. I do think that the debt ceiling and budget negotiations can largely operate on their own track. But that does dovetail with my broader point that at least for the next few weeks, it's going to be messy, hard to find an agreement. And most likely, I truly think we're going to have a punt of this deadline to the end of September to align it with our federal funding deadline.
Excellent. Cannot wait. Isaac, I also want to turn to banks because we're seeing bank stocks lose a little bit of steam here. PacWest only up 11%. Western Alliance barely positive. The regional bank index now slipping into negative territory. Is Washington, what can Washington realistically do about this to help the confidence issue?
Yeah, look, Washington's always going to ride to the rescue of the financial system if the pain is sufficiently serious. But my point to clients has been the pain is not sufficiently serious for Congress to act. And when you look at two separate segments here, number one is the regulators. Dodd-Frank took away a lot of the power of the financial regulators to act unilaterally. The FDIC does not have the power to create a broad-based guarantee program. They can act on uninsured deposits, but only if you're in receivership. So that takes them off the table. The Fed is limited in its 13.3 authority. So instead, we're waiting to see if Congress is going to act. And I can tell you right now that the pain is going to have to be far deeper than we have seen over the past few days to get Congress going. There's a little bit of conceptual agreement around core issues relating to guaranteeing uninsured deposits, but they are still nowhere close to agreeing to a viable policy.
Does it matter? I mean, I realize that's being a little glib, but as you say, if Washington will step in when there's a problem, do we need a bigger blanket guarantee?
Yeah, look, I think my point to clients is I don't believe that the current focus of the stress on some of these banks like PacWest and Western Alliance is sufficient to catalyze a congressional response. Instead, I think that you're going to have to see the pain in larger banks and banks that perhaps operate in multiple states that have both Democrats and Republicans serving in the Senate and the U.S. House, therefore to catalyze more of a response. So, look, to me, we always know that the government will step in if the pain is bad enough. For me, it's a question of degrees. How bad does that pain have to be before you see Congress act? Because the FDIC can't act unilaterally.
Yeah, so based on that, where are you actually looking? Like, what kind of regional lenders would you be looking for those cracks that really would compel Congress to do something?
Yeah, I mean, look, you're talking about larger regional banks that have multi-state presences, things like Regions and KeyCorp are the ones that you hear mentioned most often.
All right, Isaac. Yeah, it seems like you got to have a crisis to spur any action there. Isaac, really appreciate it. A great read through on what to do with the financial sector as well as the debt ceiling. Isaac Voltansky of BTIG. And the debt ceiling debate is part of today's big take, which is focusing on the challenges that Fed Chair Jay Powell is facing to avoid a recession. So definitely check that out on the terminal. All right, coming up, it was the firing literally heard around the world as media personality Tucker Carlson was abruptly let go from Fox News last month. We get earnings from Fox tomorrow. So we're going to talk to Robert Thompson, Syracuse University trustee professor, about what's ahead for the network. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Simone Foxman. Near Dallas, Texas, investigators are looking into whether the man who killed 8 people at a shopping mall was interested in white supremacist ideology. The 33-year-old man was killed by a police officer in the mall's parking lot. Witnesses say he was wearing a tactical vest that was jammed with ammunition. A new poll shows President Biden's approval rating hitting a career low. It also shows him trailing Donald Trump in early voter preferences for next year's election. According to the ABC News Washington Post poll, only 36% of those surveyed approve of President Biden's performance, and the former president leads him 44-38. In Saudi Arabia, the economy grew at a slower pace in the first quarter of 2023. That was due to the oil sector, which grew at its lowest rate in more than a year. Saudi GDP rose an annual 3.9% in the first 3 months. That compares with 5.5% in the previous quarter. Global news, 24 hours a day, on air and on Bloomberg Originals, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Simone Foxman, and this is Bloomberg. Danny.
Simone, thank you so much. Now